Hi everyone and welcome to something new. Today I'm launching a video series to complement everything I already share across X, Beehive and my other social media platforms. Every few weeks I'll walk you through the biggest market moves, the most interesting charts and the themes that matter most for investors right now. I'll try to keep it fast, clear and easy to follow. Think of it as your market snapshot, what's moving, why it matters, and what to watch next. These videos will be lighter on charts than what you're used to see on Beehive, because the goal here is speed and clarity. If you want the full deep dive, all the charts, all the data, and all the data analysis, that will still be waiting for you on Beehive. So if you want to stay on top of the markets without spending too much time, I think this format is for you. So let's get into it. First things first, I want to highlight how fast the market recovery has been and what has been driving it. As you can see, total global equity fund inflows spiked to roughly $270 billion in April, which was the highest monthly intake since at least 2021, according to JP Morgan data. This was primarily driven by ETF inflows, with leverage ETFs also contributing significant additional purchases, as rising markets forced them to automatically rebalance their positions, so essentially buying into the rising markets. Mutual funds, on the other hand, continued to see outflows, a trend that has persisted for most of the last 3 years. This suggests investors are aggressively rotating out of actively managed funds into passive ETF products. In other words, the long-term trend continues. Put simply, capital is now chasing performance globally at the pace not seen since the meme stock frenzy of early 2021. Next, across all global markets, South Korea has been the most interesting story. The chart shows that the South Korea ETF EWY is now the most actively traded fund globally, and it accounts for 14% of all global equity ETF volume. This figure more than quadrupled in just a few months and is based on a sample of 688 global equity ETFs, according to Goldman Sachs data. As a result, this ETF has surged over 200% in price, making South Korea the best performing country ETF in the world. Now, let's cover something from the US market. Uh, Basically, how sharp the recovery has been since the March sell off. Uh, the chart shows that the S&P 500 has surged over 10% in April, uh, in the month following the March drawdown, which itself never exceeded 10% from all-time highs. By comparison, there have been only 2 or 3 such instances in the past, one during the Roaring Twenties and one during the late 1990s of dot-com bubble, and this is according to BofA research data. Uh, Next, the recovery has been driven by just a handful of technology stocks, as you can see. This chart from Nomura presents that 69% of the rally since the March bottom has been driven by just the top 10 stocks, contributing 8 percentage points of the 16% rally. As it is shown on the graphic, Alphabet, Nvidia, Amazon, and Broadcom have contributed the most. In other words, the remaining 490 stocks contributed just 31% to the recent market rise, a level of concentration that is essentially unprecedented. And another chart confirms how weak market breadth has been. Just 22% of S&P 500 stocks have outperformed the index over the last 30 days. This is one of the lowest readings in 30 years according to Citadel Securities data. In other words, the average stock has not come close to the matching the S&P 500 rally. Since the March bottom, the S&P 500 equal weighted index has risen just 8%, which is half the recovery of the main benchmark. The next chart shows how explosive the upside moves have been. The ratio of up-day realized volatility to down-day realized volatility on the Nasdaq 100 index surged to 7 times, which is the highest reading on record. This simply means the index is moving 7 times more violently on positive days than on negative days. Why is this happening? Before the recovery, almost nobody owned enough upside exposures. Investors such as hedge funds who were underweight or short the market have been forced now to purchase call options to catch up, which is driving extreme one-side upside moves. The chart, uh, another chart also illustrates how explosive the upside moves have been from a historical perspective. As you can see, the top 10 performers of the Nasdaq 100 index have gained an average 784% over the last year. By comparison, during the dot-com bubble peak, the average gain was 622%, which is over 150 percentage points lower than the current run. The best performing stock today is Sandix, which is up nearly 4,000% over the last 12 months. By comparison, during the dot-com bubble, the best performer was Qualcomm with 2,600% gain in 1999, a significant difference. As you probably know, the best performing sector has been semiconductors, and this chart shows just how extreme the move has been. The SOX Semiconductor Index surged 58% over the last 6 weeks, which is the best 6-week stretch since the dot-com bubble peak of March 2000. Since the index was launched in the 1990s, this has never happened outside of the dot-com run. As a result, the sector is now the most overbought since March 2000. And this is shown on the zero hedge chart, uh, which explain that the relative strength index of the SOX semiconductor index reached 85 points, a level only comparable to the dot-com frenzy. Another indicator confirming how overbought semiconductors currently are uh, is this. So it shows that the SOX index is currently trading 60% above its 200-day moving average, according to Bespoke Investment Group data. This is the highest level since March 2000 and only the third time in the history of the index that has moved this far away from its 200-day moving average. Back in 2000, the index reached as high as 110% above its average. Adding to this, the semiconductor ETF SMH has surged roughly 160% over the last 12 months, and this gain has been so extreme it sits now 4 standard deviations above the long run average and means that this has occurred less than 0.01% of the time historically. As a result, semiconductor valuations have reached extreme levels, and this chart shows the price to sales ratio based on Wall Street analyst estimates is up to 9 times, more than 4 times the level seen in 2014 and roughly more than double the 20-year average. Overall, the rally driven by just a handful of stocks has pushed overall market concentration to record levels. This chart shows how evenly distributed the market up weighting is across the 500 stocks of the S&P 500 index, and this measure has now fallen to a record low of just 42 stocks. It simply means a tiny group of stocks is now driving the entire index performance more than at any point in the last 35 years, including the 2000 dot-com bubble as it is shown on the chart. Uh, Put simply, if you buy an S&P 500 index fund today, you're not getting balanced exposure to 500 companies. You are instead heavily concentrated in a handful of mega cap tech names. To wrap things up, the last chart also illustrates the extreme concentration of the US market. The top 10 stocks in the S&P 500 now account for nearly 40% of the entire index market value, close to a record high. To put that in a context, this matches the level of concentration seen during the Nifty 50 era in 1972, when just 50 large stocks dominated the entire US market. It also matches the peak of the dot-com bubble in 2000, and it is only 4 percentage points away from the most extreme concentration ever recorded, which was Japan in the 1980s, when Japanese stocks dominated global markets before a decade-long collapse. Now, here's the important part. Every single one of these previous concentration peaks ended the same way. The dominant group of stocks eventually lost its grip on the market, and on average, their combined weight in the index fell by more than 20 percentage points from peak to trough. That is a massive reversal, and it has happened every single time. So the question is this time different, or will history rhyme once again? Thank you for listening, and see you again in a few weeks.